Hello and welcome to this Tolley Seminars Online lecture where I'm going to be talking through the changes the Chancellor announced that affect owner-managed businesses in the budget of 2013. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley. Now the Chancellor, as one of his measures in this year's budget, introduced a simplified system of taxation for small businesses, whereby a voluntary cash basis opt-in will apply from 2013 where the turnover of the business is below the current VAT registration threshold. Now, when the Chancellor first announced this, the VAT threshold was £77,000. It will go up from April to £79,000. Now, one major change that the Chancellor has announced in the budget compared with previous announcements on this measure, which we covered previously in Tolley Seminars Online, was around the ability to opt in and out of the scheme as the taxpayer so wished. The rules will now apply, and we're yet to see the full detail of this, where the individual must remain in the scheme until their circumstances are no longer suitable for them. But that seems to be determined by a set of factors as opposed to the taxpayer choosing whether it's suitable for them. So the ability to opt in and out as the trader wishes seems to have been withdrawn. Now, what is the advantage of these simplified small business accounts? Well, potentially, and I mean potentially, the individual could actually work out what their profit is themselves by simply looking at their bank statements, adding up one side, giving them their income, deducting the other side when they add it all up, which is their expenses. The difference is their profit on which they pay tax. There's no need to make any opening or closing adjustments for accruals, prepayments and capital expenditure, etc. You just simply work out your cash basis. That's the end of civilization as many of us on this planet know it, because that means that taxpayers will be able to work out their own profit without needing to go to an accountant. That is the thin end of the wedge. But what is the advantage of going to an accountant to prepare a proper set of accounts for you? Well, that's the point I'd like to really cover here, and this is around loss relief. If the trader prepares his accounts on a cash basis because it's simpler for him to do it, the only thing he can do with his loss is carry it forward. There will be no ability to make a sideways loss claim or a carryback claim in respect of taking losses against other income in the current or previous years, which can be particularly advantageous, of course, in the opening years of a new trade, where you actually have the ability to take the loss and carry it back to the previous 3 years, taking the earlier year first, and your accountant giving you a nice tax repayment. Only an accountant can secure that tax repayment, because that will require preparing proper set of accounts based on normal accounting rules. So there's one advantage of going to the accountant, of course, is to get proper loss relief. Now, I did say deliberately that potentially the taxpayer could calculate their own profit, but will a taxpayer actually know whether they've incurred an expense in accordance with the rules, wholly and exclusively for the purposes of the trade, not allowing business entertainment or adding back purchase of property or investment assets? It's not as simple as just following the cash. Another disadvantage of cash accounts is the fact that the maximum amount they will give you for a deduction for interest on a loan taken out to fund your business is £500 a year. I don't know why they've introduced a cap, but they have. So therefore, if your interest bill is more than £500, and in many cases it will be a lot more than that, you have to go to an accountant to claim the additional interest because, of course, you'll need a proper set of GAAP accounts produced. Other expense deductions will be allowed at certain levels. Now, the Chancellor previously said that the standard mileage rate must be applied to anyone claiming mileage. He's now saying that's now optional in the fact that you will be able to claim the actual costs of running your car multiplied by your business proportion, but there does appear to be a caveat that you cannot claim any capital cost of the car. Now, previous announcements have said that if you actually claim business use of your home, for example, you sit in your back bedroom between 25 and 50 hours per month, working on your business allow you to claim the generous £10 per month. If you work a bit more in your home, that's going to be £18 per month. And if you work a lot more in your home, that'll be £26 per month. But there will be flat rate deductions. Again, they're not cash. They're not things that appear on your bank statement. They're adjustments you need to make. So if you're paying your home electricity bill completely out of your business bank account, you're going to have to add it back and then deduct these separate fixed sum deductions. Will taxpayers really know how to do that? I doubt it. There'll also be opposite deductions. For example, if an individual is living in their business premises, for example, they run a guest house or a small hotel, then the rules work another way round. In the fact that if you've got one occupant living there, then you claim all the costs of running those premises, but you add back £350 per month for the fact that you've got an occupant living there. For 2 occupants it's £500, and for 3 or more it's £650 per month. They will let you claim the full cost of your home telephone and internet services where your private use is small, with no definition of small, and they will allow you to claim flat rate subsistence, for example for lunch or an evening meal where you're working away from your business premises, based on new HMRC guidance, so based on what HMRC can claim for their journeys. We're yet to know what that level is. Now, another change that Chancellor has introduced for business is a change in the annual investment allowance, which seems to have been a bit of a football they're kicking around here. Now, this has moved quite considerably from the original £50,000 to 3 years ago increasing to £100,000, last year reducing to just £25,000, and then from 1 January 2013 increasing to now £250,000. The Chancellor, or Chancellors, because of course it included Alistair Darling as well in this, cannot make their mind up as to whether they want business to invest in capital plant or not. But clearly it does seem to be in vogue at the moment. Now, this is going to only be a 2-year window, in the fact that you have to incur your capital expenditure in the 2 years starting 1st January 2013 to ending on the 31st of December 2015, and legislation has already been put forward in the draft finance bill to withdraw the relief down to the previous £25,000 limit with effect from 1 January 2015. So it is a question of timing. Obviously notify clients that this relief has gone up considerably, and a way that the rules cut in, of course, is that they only really truly cut in when you start a new accounting period any time from the 1st of January 2013. So if you have, say, a March year end, then you really don't get your £250,000 in full for the year ended 31st of March 2014, but you do get a little bit of the uptick from January of this year, provided you spend that money in that period, 1 January to the end of March. In previous Tolley Seminars Online lectures, we have gone through with you what happens if you have a January, February or March year end in 2013 and how that impacts on your ability to claim the new heightened level of AIA. I draw your attention to those previous lectures on the service, which you can do a search under AIA for. The Chancellor has also introduced new corporation tax rates for 2013-14, with the main rate reducing to 23%, effective from the 1st of April this year, with the main rate falling to just 21% from April 2014, and at last he's done it. From April 15, the main rate will fall to 20%. That means that the small profit rate, and he announced this in his speech, will be abolished. That, to me, is true simplification of the tax system. No need for the additional complication of working out marginal relief fractions where your profits are between 300,000 and 1.5 million. Now, the key for me is around profit extraction. It appears then that the general regime for profit extraction from a small limited company remains unchanged from anything we've seen in this budget. And it's unlikely to change before 2015 based on what we know. So therefore, setting up your trade through a small limited company where your profits are anything from £40,000 or £50,000 upwards is very beneficial. You basically put the profits into a company and you withdraw those profits by way of a personal allowance level of salary and the balance by way of dividends. And if you can involve a spouse in ownership of the company at the same time, then of course you can take advantage of 2 basic rate bands. So it is worth you reviewing any remaining sole trades and partnerships for which incorporation could be worthwhile, because the benefits are clearly out there still to be had, at least for the remainder of this Parliament. Now, the Chancellor introduced changes in this year's budget to closed company loans. A number of things have been done to broaden the definition of a loan to a participator with effect from the 20th of March 2013 to include loans to partnerships and trusts, to bring transfers of value other than loans into scope to the Section 455 charge, and to prevent bed and breakfasting, i.e. repaying the loan and then taking it back out again a few days later. Let's look at each in turn. Loans to partnerships and trusts. This will bring loans to corporate partners into scope for certain. Now, HMRC, in their technical note that was published on the day of the budget, makes it clear that as far as they are concerned, the rules apply to corporate partners anyway, and they will always seek a Section 455 charge. However, new legislation has been brought forward to put that beyond any doubt whatsoever, and therefore HMRC will have a greater chance of winning any argument there. With regard to loans to trustees, they are definitely going to be brought within scope to Section 455, where shares in the closed company are held in a trust, or a loan is to a trustee who are associates of a participator. So that is going to be abundantly clear again. HMRC think that the rules already cover these situations, but new legislation will put that beyond any doubt whatsoever. With regard to transfers of value, again these rules are aimed at corporate partners where profits are not withdrawn from the partnership. Basically, where the company withdraws excessive capital, then this will count as a loan and trigger a 455 charge. HMRC saying that this will put the matter beyond doubt. They already do go after excessive capital withdrawals under Section 455, but the new legislation will make the teeth of the rules bite that much harder and be that much more certain. The legislation is yet to be tested in the courts based on what it read up until the 19th of March this year. Now, there's going to be a brand new rule over bed and breakfasting which has not previously been in the legislation, a new 30-day rule, where the relief that you currently can get from the Section 455 charge will be withdrawn where more than £5,000 of the loan is repaid, and that is reversed within 30 days following that repayment. In addition, where the loan exceeds £50,000 and there is an intention to withdraw the repayment that's made before the tax is due, then again the 455 relief will not be given. Well, those are the main business tax changes that apply in this year's budget of 2013. There are many more changes that affect large companies, which is beyond the scope of this particular lecture, but if you wish to look at those, we do have the accompanying notes to this budget release if that is of interest to you. But many thanks for listening to this lecture on the business tax changes of Budget 2013. My name is Chris Jones, Director of Tax Markets and Learning Solutions at Tolley.